as far as the markets are concerned. Florian Neto, Head of Investments Asia at Amundi, is with us. Florian, we have you at a very interesting juncture. Great morning. I don't know if you could hear some of those sound bites that came in from Peter Navarro. But as someone who's managing so much of money out of Asia, these changing political equations, or at least shifting political equations, how much credence are you giving to this? I'm sure you're watching it, but is it impacting your decision-making at all? And, you know, what are your thoughts now over the last couple of weeks in India?
Yeah, thanks for having me. Yeah, well, if we sum up what we heard overnight, it's slightly more conciliatory tone from Trump, in our view. It's the last bit of negotiation, so the pressure is mounting, and we have some hawkish talks, as has been mentioned by Peter Navarro just now. From a foreign investor point of view, investing in India, yes, for sure, you're looking into the level of tariff at the end of the day, and the levies has been up and running now, and it's the highest among the Asian countries. So it's definitely lowering the competitiveness of Indian companies. But then at the end of the day, I think everybody is looking at the GST this week. And GST is a way eventually to offset a bit of those tariffs from a sentiment point of view, but as well from companies. When we look at the foreign flows over the recent, let's say this quarter, you've seen that large foreign outflows, almost $5 billion have been leaving India, despite the fact that domestic equity fund flows remain quite steady. In our view now, we are reaching to a point where the valuation, it has always been one of the headwind for Indian equity, valuation and positioning is now returning in favor of India. So the RSI, for example, the technical, are approaching oversold territory. So after the GDP, and I think the Q2 GDP is surprisingly high, and I think our economists have been saying we should take this with a pinch of salt. But anyway, when you look at August economic data, they are showing some pickup. So now we are left with GST. And if GST is aligned with what the market is expecting, then it will boost further consumption stocks. And I can drill deeper into the consumption-sensitive stocks. If it's lower than expected, then we will have a retreat on those stocks, those durable goods, those auto, those packaged foods. And on the contrary, those capex-sensitive stocks can perform well. So we are at a juncture where everybody's looking at GST and maybe listening slightly less to what's coming out of the US, while waiting if there is something coming in terms of the level of the tariff for India.
Florian, hi, good morning. Did you start by saying that maybe this is seeming a little less confrontational, President Trump's post? Or did I miss here?
Yeah.
No, yeah, exactly. Slightly more conciliatory tone in our view. Because saying that, well, they offered this, but it's getting late, means that, yeah, they acknowledge that India is at the table of negotiation.
It's late rather than never.
Exactly. This is how we are taking it as well. But we don't know. While we are all sitting at the same on the same spot there and waiting at what's happening. But there is willingness for India to get this down.
No, I mean, that's what I thought. That's what I began my sort of summary of events with as well, that maybe a little less confrontational, that truth social source. But as you said, we don't want to read too much, right? And of course, you can't make investment decisions based on, it's just the vibe of it, which felt a little conciliatory, not conciliatory, but less confrontational. Florian, so where are you? You said GST is the next big one, right? So the entire consumer sectors will be in focus. And so you said if they are meaningful, what is meaningful, which will help these stocks do well? And where do you think we will get the most bang for the buck from an investor point of view?
Well, I think if you get what is expected in terms of subs, from 25 to 15, for example, and then those companies are grouped in the same, I think it will be a significant change. It will be a great boost to consumption, and then we will dig deeper into those packaged foods company, into those auto companies that we perceived as the beneficiaries. The Indian consumption stocks of the last 2 weeks have already rallied a bit. When you look into consumption stocks versus other stocks, you see that it's already happening. But on the other side of it, we have as well investment in some oil marketing companies, and those are actually suffering from a bit of headwind right now, because there is the other side of the coin. If we have a reduction in GST tax, then there is tax revenue loss for the central governments, and then if it sticks to its fiscal targets, that is our view, it's eventually the risk is moving to a curve in terms of capex, and those capex sensitive stocks can eventually be negatively impacted. So there will be a very much a juncture between the type of thematic. If GST tax is relatively substantial, then it will be a good boost for consumption sensitive, but the capex sensitive stocks will be a bit lagging behind in our view.
All right, Florian, final question before we let you go. MSCI India has actually underperformed MSCI emerging markets in the last 1 year. If you look at it, we are down by close to 10%, while MSCI emerging markets is up close to around 13-14%. However, in the last 10 years, we have been out and out outperformers. Do you think India gets back to its outperforming ways in the next 12 months?
Well, it's a good one. And I think one of the, how to answer to that is what the others are doing as well. All our investors right now are asking questions on what's happening in Korea, what's happening in China, and they are not asking what's happening in India. So basically, I think China is the hot topic of the summer because it was uninvestable 2 years ago. And it has been now a market you cannot ignore anymore in a strategic asset allocation point of view. The rally we've seen is very much liquidity driven, but it's driven by local retail investors, as India has been driving its rally over the years. Foreign investors have been pouring money in, but actually it has been as well moving a lot because of retail investors. And this is how a sustainable rally is coming. So in our view, India will come back, but it may take further time, depending on how sustainable is the current rally we are seeing in China. Because foreign investors are very much underweight China and they are underweight India, but the structural allocations they have in India over the years has been larger. So they feel that they are missing out a lot of what's happening in China. So if anything, I do believe that if eventually you have a further reallocation from Chinese investors out of fixed income, out of excess saving, out of corporate cash into Chinese equity market, it can be very, very large in terms of free float market cap, and it will become something that investors are looking for. So over the next 12 months, you said, I do believe India will have time to catch up, but over the next 6 months, I do believe that China and the sustainability of the rally will be the main focus point for investors in the region, in the Asian region.
Well, that's very well explained, Florian, and you can't blame investors, right? I mean, the Shanghai Composite itself is up some 18-19%. Individual stocks have done even better in China. So yes, the spotlight is on the dragon, but let's see, elephant maybe catching up as well. Yeah. Thank you so much for joining in, and we look forward to the next conversation. You have a great day. Well, that's a view coming in from Amundi.